Hello and welcome to the 9th episode of this series on stock investments. In my previous videos, I have tried to explain the basic concepts of stocks and their working in the simplest way possible. In this episode, I will be explaining the investment strategies because to achieve anything in life, you need to create a strategy. Investment without a strategy can be risky and is similar to searching for a treasure without a map. So let's dive in with the popular and prominent investment strategies that has been followed by a lot of successful investors in stock market. Firstly, we will be understanding the three major strategies known as value investing, growth investing, and dividend investing. After that, we will also shed some light on portfolio diversification and understand the active and passive forms of investing in the stock market. Now let's start with value investing. As the name suggests, it is an investment strategy that is based on the valuation of the stock. Simply put, it is the strategy in which investors search for undervalued stocks that have the potential to grow in the future. Warren Buffett, the famous investor, followed this strategy to become the most successful investor in the world. So how can you follow the value investment strategy? In our previous video's fundamental analysis, we have understood how to compare valuation of stock. You can check the PB and PE ratio of the stock and compare it with the PB ratio and PE ratio of the industry average. If the PB ratio and PE ratio of the stock are lower than that of the industry average, the stock can be undervalued. These two ratios also need to be compared with their historical value to check whether they are currently undervalued or not. Another popular investment strategy is growth investing. Unlike value investing, the valuation of the stocks does not matter a lot in growth investing. The main focus is on companies that exhibit signs of above average growth. Even if the stock price appears high in terms of PE and PB ratio, investors in growth stocks are mainly looking for companies that are expected to grow sales, earnings, or cash flows at a significantly faster rate than the market or their peers. Companies like TCS and Zomato were popular targets for growth investors in their early stages, owing to their revolutionary business models and rapid growth prospects. The key difference between value and growth investing lies in the approach and the type of companies targeted. Value investors look for stocks that are undervalued by the market and have strong fundamentals, expecting the market to realize the stock's true worth over time. Growth investors, on the other hand, may overlook traditional valuation metrics and invest based on potential future earnings and market dominance. While value investing seeks safety through bargain prices, growth investing rides the waves of companies' potential explosive growth. Moving on to dividend investing. This strategy focuses on companies that pay regular dividend. Dividend investors seek out companies with strong histories of dividend payments and the potential to increase those payments over time. Such companies are usually well established and financially stable, providing investors with a regular income stream along with the potential for capital appreciation. Utilities and consumer staple companies are typical examples of dividend-paying stocks that attract conservative investors who prefer steady returns. Now let's discuss the approaches to managing investments in the stock market. Active and passive investing. Active investing involves frequent buying and selling of stocks to capitalize on short-term market movements. It requires a hands-on approach and often involves higher fees due to the need of active management. Passive investing, in contrast, involves buying into a broad market index or fund and holding those investments over the long term. This strategy is based on the belief that it is hard to consistently outperform the market, so it focuses on building wealth gradually through market exposure with lower fees. Incorporating these strategies within a diversified portfolio can help spread risk and enhance potential returns. Diversification means not putting all your eggs in one basket, but spreading your investments across various sectors, geographical regions, and investment styles. This approach helps in mitigating risk and taking advantage of different growth opportunities within the market. In conclusion, choosing the right investment strategy depends on your financial goals, risk tolerance, and investment horizons. Whether you lean towards the safety of value and dividend investing, the potential high returns of growth investing, or a mix of strategies, ensuring your portfolio is diversified and aligned with your investment objective is the key to achieving financial success in the stock market. Thank you for watching, and I'll see you in the next video where we will delve into costs associated and taxes incurred in stock investments to help you refine those strategies further. Until then, happy investing. Investments in securities market are subject to market risk. Read all the related documents carefully before investing.